Retirement brings more than just a change in lifestyle, it also changes how you are taxed. And contrary to popular belief, retirement doesn't necessarily mean the end of taxes. So that's why it's important to understand how taxes are applied in order to optimize your tax position to make your retirement savings last longer. In this video, I'll cover the main types of taxes you'll face in retirement, including the relevant tax rates and possible ways to reduce it. I'm also going to reveal the #1 tax strategy that you can implement leading into retirement that will save you thousands of dollars in unnecessary taxes. I'm Chris Strano, Managing Partner of Toro Wealth, where we specialise in providing retirement planning advice for 50 to 70-year-olds. I'm also the founder of superguy.com.au. As always, this video is general advice only and does not constitute personal financial advice, so please read the disclaimer below. So, if you think you're done with taxes after retiring, think again. Unfortunately, taxes follow you into retirement. However, when you retire, you have more opportunities to reduce or even eliminate certain taxes. So let's have a look at the 7 types of taxes in retirement. The 7 main types of taxes in retirement include tax on superannuation earnings, tax on superannuation pension income, tax on Centrelink age pension income, tax on work-related income, tax on personal investment income, tax on personal capital gains, and tax on superannuation contributions. Let's explore each type of tax individually so that you can gain a complete understanding of each one. Firstly, tax on superannuation earnings. So in retirement, your superannuation can be held across 3 types of accounts. The choice of account depends on factors such as financial situation, age, strategy, and personal circumstances. These accounts include #1, a super accumulation account. And this is a regular super account that you have while you're working that either you and or your employer contribute to. #2, a transition to retirement pension account. This is an income stream that you are eligible to start once you have attained age 60, even if you are still working. It's designed to allow partial access to your super as you wind down into retirement. And #3, an account-based pension. This is an income stream you can start once you are fully retired and provides regular payments to cover your retirement expenses. There is no limit on the amount you can withdraw each year in an account-based pension. In each account, your superannuation balance will be invested and presumably earning an income, as well as potential capital gains. The taxation on these earnings will differ depending on the type of account. Firstly, tax on income earnings. So all income such as dividends, rents and interest earned from investments will be taxed at 15% within an accumulation or TTR pension account and 0% within an account-based pension. And secondly, tax on capital gains. All realised capital gains will be taxed at 15% within an accumulation or TTR pension account, but this CGT will reduce to 10% if you own the asset for longer than 12 months. Capital gains tax in an account-based pension, on the other hand, will be 0%. Many people mistakenly believe that all pension earnings from super are tax-free from age 60. However, as I've just explained, it's the type of account you hold in your super that determines the tax on earnings, not your age. If you want to understand more about how to reduce tax through super, download my 6-step super check. I've put a link to it in the description below and it's free. Okay, so now that covers tax on superannuation earnings, but what about tax on superannuation pension income? So if you start an account-based pension or a transition to retirement pension, you will receive regular income from your superannuation, and this income will be received completely tax-free. The only exceptions to this is if you are receiving account-based pension income while under age 60, and or if your pension income includes an untaxed component. So you might have an untaxed component if you have been granted access to your super due to a disability or insurance payout. Another type of superannuation pension that you could be receiving, and this is generally associated with government and semi-government employees, is a defined benefit pension. To keep it simple, defined benefit pensions from a taxed scheme will usually be received tax-free, whereas defined benefit pensions from an untaxed scheme will be taxable. Moving on to tax on Centrelink age pension income. Once you have retired and reached age 67, you may be eligible to receive Centrelink age pension payments. To determine your eligibility for full or partial payments, the government will perform an income and assets test. If you are eligible, these age pension payments are added together with any other types of taxable income and then fully assessed for personal income tax purposes at your marginal tax rate, which can range from 0% to 47%. The actual tax rate payable will depend on how high your other forms of taxable income are in any given financial year. Another type of income that might be taxed at your marginal tax rate is work-related income. Despite being retired, you might choose to indulge in some casual or part-time work for a little bit of play money. If you do decide to work while retired, any income earned will be fully assessed and taxed at your marginal tax rate, again anywhere between 0 and 47%. One way of reducing taxes on personal income such as this is by making personal deductible contributions to super, which provides you with a personal tax deduction equal to the contribution amount. But just be mindful of the rules and limits around how much you can contribute. I have another video that covers personal contributions in detail. The link to that video can be found in the description below. In addition to the age pension and work-related income, the other type of income that is assessed for tax in retirement is personal investment income. You may own shares, manage funds, or an investment property, which is providing you with income in the form of dividends, distributions, and rent. Bank accounts and term deposits will also generate interest. This investment income is added together with all of your other sources of taxable income and then taxed at your marginal tax rate. The tax rate on investment income, again, can range from 0% to 47% based on the level of your personal assessable income for that year. Depending on your age and contribution limits, this taxable income may be able to be reduced through personal deductible super contributions and other tax deductions, which I'll cover in more detail later in this video. Another type of tax you may pay in retirement is capital gains tax on investments that you own in your personal name. Capital gains tax may be payable when an investment is owned in your own name and sold by you and the sale price was greater than the purchase price. When this occurs, the profit you make will be assessed for capital gains tax. However, if the investment you sold was owned for longer than 12 months, then only half of the profit will be assessed for tax due to the 50% general capital gains discount. The tax rate on capital gains will depend on your marginal tax rate because the assessable capital gain is added together with your investment income, work income, and any other taxable income. As mentioned, your personal taxable income can be reduced by making deductible contributions to super, but you will need to be mindful of contributions tax to ensure that the deductible contribution will be financially beneficial. Speaking of super contributions, how are they taxed in retirement? Any contributions you make to super will fall into one of two main categories: concessional contributions and non-concessional contributions, which are taxed differently. So non-concessional contributions, including personal contributions, downsizer contributions, spouse contributions, and small business retirement exemption contributions, will not incur any contributions tax. The full amount of each contribution will be added to your super balance. Concessional contributions such as employer contributions, salary sacrifice, and personal deductible contributions are taxed at 15% when added to your superannuation. And for very high income earners, an additional 15% tax known as Division 293 tax may also apply. After contributions tax, the remaining amount is added to your super balance. Unfortunately, there is no way to reduce or eliminate contributions tax. Alright, so that covers the 7 types of taxes you may incur in retirement, each of which affects retirees differently based on things such as income sources, assets, and super contributions. Now, at the start of the video, I promised to share with you the #1 tax strategy leading into retirement, and here it is. Optimizing your personal concessional contributions. A personal concessional contribution is a contribution that you make into super and claim a personal tax deduction for. Optimizing these contributions before retirement not only reduces your personal tax, but you're also investing more of your wealth into super where earnings can be received tax-free throughout retirement. Let's take a look at how powerful this strategy can be, because this is a very common strategy that we recommend to our clients every single day. So if we were to assume that you are an employee earning $100,000 per year, you could contribute up to $18,500 as a personal concessional contribution, in addition to your regular employer contributions of 11.5%. By contributing $18,500, you reduce your taxable income from $100,000 down to $81,500. This would then reduce your personal income tax from $22,788 down to $16,868, a saving of $5,920. However, contributions tax of 15% or $2,775 will be deducted from the contribution, but there is still a net saving of $3,145 in tax, and you can do this every single year. But it gets better, because if you have a super balance of less than $500,000 as of the most recent 30 June, then you can contribute unused amounts from the previous 5 financial years in addition to this year's cap amount. So in our example, assuming you had adequate unused amounts, you could contribute up to $80,000 in this financial year, which would reduce your personal income tax payable from $22,788 down to $0. Again, contributions tax of 15% or $12,000 will be deducted from the contribution, but there is still a net tax saving of $10,788 in this year alone. If you want to learn more about utilizing unused contributions from previous years, I have a separate video on that one alone and have put a link to it in the description below. But that's not where the tax savings end, because now that you have contributed this $80,000 to super, all of the investment earnings from this amount can be received tax-free throughout retirement. And these tax savings, compounded year on year, will mean that you either have a higher income in retirement or will make your super last longer, or both. While taxes don't stop in retirement, there are plenty of strategies to reduce your tax burden with the right planning and understanding of the rules. That's where we can help. At Toro Wealth, we specialise solely in retirement planning advice. Our aim is to give you confidence around when you can retire, the retirement income you can achieve, and how to optimise your financial position and tax in the lead up to retirement. If you're interested in learning more about our service and cost, head over to torowealth.com.au.